Welcome to Alternative Investing. I'm Mark Bunting, here with my co-host David Kaufman, the president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that to help you break away from the pack and potentially capitalize on some big gains. This week, we'll be taking a look at due diligence with respect to exempt market products. But first, what is an exempt market product? Now, these are kinds of investments that are not publicly traded and are illiquid. Potential investors will need to conduct some careful due diligence with these. And let's expand on that, David. Again, what exactly are exempt market products and the structure and the kind of research you need to do?
Technically, anything that's not sold through a prospectus is an exempt market product. So a prospectus would typically be linked to publicly traded securities, which we hear about all day on BNN. Whereas exempt market products, as you just said off the top, are both private, typically, and illiquid, which means that because they're private, people, as they go through that calculus of whether to invest, they're investing in something that's almost always smaller and, if not opaque, certainly less transparent than many publicly traded facilities. In addition, almost by definition, they're less liquid. They're less liquid on two levels. The first level is that they can't be publicly traded, so that if someone decides they made a mistake, they can't sell that security on the open market. And the underlying securities within funds, whether it be apartment buildings or mortgages or private equity, are themselves illiquid, which is why the fund itself is illiquid at the same time.
So who can buy these products?
It depends where you live in the country. In Ontario, where we have the strictest rules and regulations through the OSC, one has to be an accredited investor in order to buy an exempt market product, which basically means that they have financial assets in excess of $1 million or that they earn more than $200,000 in each of the last 2 years. Whereas out west, they have what's called the offering memorandum exemption, which is that if a product is sold through a official offering memorandum, that essentially anybody, the rules change from province to province, but essentially anyone can put as little as $5,000 into these products, which is why the exempt market is more vibrant out west than it is in Ontario, strictly because there are more people that are able to invest in it.
And we have a guest tonight based in BC, and he'll expand on that. Now, let's talk about the research that you do, the due diligence that you do, and that others do on these products. What are you looking for specifically?
I have a little list with me here because there's a bunch of things that whether it's a lawyer or an analyst would want to look through in the offering document. So first things first, you want to look at the offering memorandum and the other subscription agreement and other offering documents that come along in that process. The first thing you'd want to understand is the fund structure and the operation. So who owns the fund, what's the legal structure, and what are the rights and obligation, both of the investors and of the fund managers themselves. The next thing would be management team and experience. And of course, this is very important because you're handing your money over to a team who are going to manage it for you. What are their qualifications? Is this their first fund? Have they had other funds in the past? And it raises an interesting question. In many cases, fund managers, it might be their first fund, but they've run hundreds of millions, if not billions of dollars, for example, at a bank on what's called a prop desk and a proprietary trading platform, where they have a lot of experience dealing with the strategy that they purport to perform under their new fund, but they may not have had similar funds in the past. Then you'll, of course, want to look at fund performance. How have they done in the last 3 to 5 years? And in a sense, although no one wishes 08 to ever happen again, it's very instructive for an analyst to look at 07, 08, 09, because you had up, down, up on the markets. And you can see how that fund manager was able to execute his or her strategy during that period. And you can also sense what kind of volatility you might be getting into, how bumpy the ride may be if any of the unhappiness of 2008 were to return. Then you have, of course, management and performance fees. These managers want to get paid. In many cases, they left other jobs where they had lower pay in order to open, say, a hedge fund or other type of exempt market product. The classic fee is called 2 and 20, as we've talked about in the past. What you want to make sure in that analysis is that the alignment of interest is there between the management and the investors, so that they have that alignment as they move forward over what could be a 3 to 7 year period. Operational risk and risk management, which I'm sure we'll talk about with our guest today, which covers who drives the bus and how do they do that and how many redundancies are there and how is it structured. Liquidity is a very important issue. How do I get in? How do I get out? How long am I locked up for? Can I redeem? Are there penalties? and can they ever lower the gates? In certain circumstances, they might not be able to give me my money back when I most require it. And finally, I'd want to look at the auditor and the service providers. As we saw with Madoff, the fact that the auditor was someone's brother-in-law is not a good thing, and the other service providers might matter as well, whether it be tax or legal, because you don't want to get a surprise from CRA, for example, in the future saying that a certain tax structure was not compatible with their rules and regulations.
All right, so is it possible for a sophisticated investor, or one who thinks that he or she is, to do this research his or herself, or is it always wise to go to a third party? I
think it's always wise to go to a third party. It is possible to do this yourself, but the amount of time and effort and resources required probably wouldn't make it worth it for a single investment. So I would always seek out an independent, that's an important thing, that they be an independent third party to do that analysis, and it should be either a chartered financial analyst, a CFA, or a chartered alternative investment analyst, which is CAIA, and those are people and firms that are trained to do just that exact type of analysis.
And David, just lastly, we'll wrap up this segment with the various categories of risk that are important.
There are three main categories. The risk of loss of capital. Am I going to lose any of the original principal that I invested? You have to measure those risks. The investment risk, which is what are the likelihood of that manager being able to deliver to me the kind of returns that they promise in the offering documents. And the operational risk, which I alluded to earlier, which is if one person's driving the bus, what might happen if that person were to get hit by another bus? What would happen the next day in terms of unwinding securities and holdings? And would it be terrible for the fund, or would it be something that they'd be able to overcome because they have those redundancies in place?
All right, David, that's a great table setter. Coming up, we will find out what a couple of pros say about exempt product due diligence. Coming up after this. Welcome back to Alternative Investing. I'm Mark Bunting, here with my co-host David Kaufman, president of Westcourt Capital. Our topic today is due diligence of exempt market products, and we're joined now by David Paterson, president of Paterson Associates, and Brian Tang, president of Fundamental Research Corporation. Welcome, gentlemen. Now, we want to start with you, Brian, and find out from both of you, actually, who your clients are exactly and what specifically you do for them in terms of providing services.
Sure. Since 2003, we've been doing independent research on small and micro cap companies. About 2 years ago, we started to do due diligence on exempt market products. So we analyze these products, and the main focus is the economics. Do they make sense? And they're basically for investors to help them out with their due diligence.
And David, are you similar, somewhat different to what Brian does?
Somewhat different. My focus tends to be more on managed money products, while I'll do mutual fund and hedge fund research for individual financial advisors as well as mutual fund dealers. I also do some exempt market research as well, where I'll focus on hedge funds, mortgage investment corps, and some limited partnerships as well.
Now, we brought up the name Madoff last week for obvious reasons. How has that changed your business in terms of that scandal and being even more aware to avoid those kinds of pitfalls?
In my particular case, it's been great for business, and Portis before that with the hedge fund scandal. But with respect to it, a lot of advisors and a lot of firms are now taking a more serious look at the types of products that they allow their advisors to sell.
And Brian, your take on that?
And I feel the same way as David.
And let's go a little further. One of the things that we've learned about Madoff, mostly through Markopoulos and others, is that it was detectable. And part of it should have been detectable at 60 miles an hour because of the fact of who the auditor was and the complete lack of independent service providers. So I'm interested in understanding the importance, the relative importance of the auditor versus other providers, and what it is specifically that you look for to sense if there's a rat.
In my particular case, I look for two things. I look for a name brand custodian or prime broker. So I want to see one of the big names, like a TD Waterhouse or Citi or somebody like that in the role of custody or prime broker, because that is a reputable firm that is going to be holding the assets on behalf of the investors. You also want to see a big name brand auditor in there. You want to see one of the top 5 or 4 or however many's left at the helm, rather than some small little shop. With that larger firm, it gives you an extra sense of confidence that the fund is actually being audited on a regular basis.
And Brian, I know that a lot of the products you look at have different types of tax wrappers, and so there are tax opinions associated. Mm-hmm. What experience do you have taking a look at those service providers?
So what we do is we also look for the big name auditors. A lot of the deals that we analyze are real estate projects, and in those cases there'll be independent valuations done. We want to see who's done the valuations, Are they credible? What's their track record like? But in the end, we can't be auditing the auditors. We have to somewhat rely on these people because we are not auditors. So in the end, I think if someone wants to do a fraud, it will happen. But
And speaking of, it would typically be, of course, the fund manager, and we alluded before the break to the issue of operational risk. And I'm interested in understanding what drives operational risk, and what would you look to see to mitigate that kind of operational risk so that the investors have some sense of certitude that their money will be safe?
Well, the first thing that I look for is what we just spoke about, is you want to make sure that there are key reputable firms in the area of custody, in the area of audit. I also preferably would like to see an external third party that does the valuation so that you know that the price that you get is going to be reputable. You also like to know that the manager that you're dealing with has a track record. You want to make sure that they haven't been involved in any regulatory scandals or things along those lines.
And Brian, continuing on this theme, how important is it for you and for your clients that the managers of these exempt products have a lot of so-called skin in the game? They have a vested interest.
oh, it's very important. We want to see management with at least 5 to 10% interest in their projects. 20% is considered very good, and that would align their interests with those of the shareholders.
Let's drill down a little bit more on that, because there's a difference between what percentage of the fund their own assets represent and what percentage of their own net worth that represents. So in your experience, would you like to see most, if not all, of that manager's money be in his or her own fund?
We have to be reasonable about that, because just like any other investor, they would want to diversify as well. So if a huge portion of their net worth was in it, yes, it would align the interests, but at the same time, it might not make sense for them. But we would like to see a large portion owned by the management.
And David, as far as fees, David mentioned earlier the classic 2 and 20 structure with hedge funds. What about striking a balance between the management fees and the performance fees?
Well, the key is to make sure that the manager gets paid and they have enough money to keep the lights on. And the issue that I see with making the performance fee too high, going beyond that 20, is that it gives them incentive to take a little bit more risk than they might otherwise in order to generate that performance fee. One of the things that I do like with respect to a lot of performance fees is that they have a high watermark or some other mechanism in place to ensure that they don't start receiving performance fees until the investor is made whole again. So again, you want to make sure that there's that balance.
That brings us to the issue when you mention the waterfall of who gets their money back first. And so there's often, in the sense of performance fees, there's usually a hurdle, and then after that there's a preferred return to the investors. And Brian, I know that you've alluded in the past to the question of the investors having a first call on the capital. What's really important to understand in that regard?
What's important to understand is when the real estate project is finally developed and the cash flows are starting to come in, where do the funds flow first? We like to see the investors first get a return on their capital and then some sort of profit sharing with the management and the investors.
And Dave, if along the way, typically we have a limited partnership set up. So you have the limited partners, you have the general partner who's running the show. If the limited partners believe that the general partner is not being a good custodian of their assets, what can they do about that? Are they stuck? I mean, who has the voting rights, and what do you like to see in that regard?
To be honest, a lot of the hedge fund product that I've looked at has been not an LP structure, but more of a trust or a corporate structure rather than the LP. And in a situation like that, there are certain, in some cases, there are instances where shareholders can, if they get a certain level of support, go in and call for a meeting to have the removal of the manager.
All right, gentlemen, we'll take a short break there, and we will come back on alternative investing right after this. More on the research and due diligence for exempt market products.
David Kaufman is one of Canada's leading experts on alternative investing. He's the president of Westcourt Capital, a registered exempt market dealer.
Back to alternative investing. We are looking at due diligence on exempt market products. Still with us on this rather complex topic are David Paterson, president of Paterson and Associates, and Brian Tang, president of Fundamental Research Corporation. Not to mention, or not to forget, of course, David Kaufman, my co-host from Westcourt Capital. And Brian, we'll get back to you here. I understand there are some very big differences between exempt market products in the western part of the country versus the eastern part of the country. Give us a sense of that.
What we found is the regulatory requirements in the east and the west are different. For example, in the west, there's what's called the Friends, Family, and Close Business Associates exemption, where people can raise money from those types of individuals. In Ontario, the definition of that is much narrower. So in the West, you'll get more mainstream focused products, individual land projects, whereas in the East, the focus is more on institutional investors.
And David, what's your impression of the differences between West and East?
What I found is that in the West, it does tend to be a little bit more land focused, like a land banking deal or something like that, where in the East, it tends to be more of a REIT, a real estate investment trust, or mortgage investment corporation, or a hedge fund. I also find that the investor appetite out West seems to be a little more accepting of alternative product than it is in the East.
Interesting.
I'd like to turn the page for a minute to understand about who pays you and how that affects you. One of the things that we learned in 2008, if you look at the rating agencies, they played a really big role in issuer-paid research and in unfortunately, the dramatic fall of many of the securities that were sold during that period. So I'd like to know, do either of you do issuer-paid research where the fund manager hires you to do the research? And what happens if it's negative? How do you deal with the inherent conflict with doing that kind of research?
Okay, so we do engage in issuer-paid research where the issuer does commission us to do the due diligence on them. How we mitigate the conflicts is we charge a fee upfront entirely in cash. We will not accept securities of the issuer. They must sign a contract with us that basically gives up all their rights for recourse in terms of suing us for negative opinions. They can't prevent us from issuing research once they've engaged us. And we really keep the analysts separate from the business development process. So once the issuer has signed up for due diligence, we tell the analyst, you go ahead, you do the due diligence, whatever you think is what we'll publish.
So it's possible that an issuer might hire you, you have a negative report, they may not disseminate it, but it might be disseminated by you and sold to other investors.
Correct. For public companies especially, we will disseminate it regardless of whether it's positive or negative recommendation.
And once these reports are done, let's talk about distribution, because of course you don't sell the product, you just do the analysis on the product. So you provide the analysis, and how do these products end up getting disseminated to the public, and where are the commissions flowing in that scenario?
With the majority of the products that I tend to look at, it is sold through a broker-dealer network, so to be a financial advisor, a mutual fund dealer, or somebody with an exempt market dealer. As far as the commissions, that will then be paid to their dealer, and then the advisor will be paid by their dealer.
With the products that we're analyzing, there's really two types of exempt market dealers that will distribute these products. One sort of are issuers themselves that disseminate their own product, and there's other ones that remain completely third party and will not do their own issues and will distribute other people's issues.
Hey, Brian, in general terms, when you're doing your research, what are the red flags that you're looking for, or what stands out sometimes, the things you want to avoid?
You want to avoid management that has been in some sort of trouble with the Securities Commission. That's very easy for the investors to search. You go on the Securities Commission website, you can look at people that have been sanctioned. We would like to look at the track record of the management team. Have they successfully done these types of projects in the past? What was the return to the investor?
And that's interesting. Proficiency requirements sort of have two bars. One is sort of the minimal bar that a Securities Commission would require in order to be a fund manager. And then there's the proficiency requirement that you would expect in order to be able to give a positive review about that. And Dave, where do you fall in terms of the kind of level of expertise and experience that you would expect the fund manager to have?
Well, the first thing that I look at is what have they done in the past? What products have they managed? What is their track record? In a perfect world, I'd love to see 5 to 10 years of experience running a almost identical mandate to what they are. Obviously, that doesn't happen a lot of the time, but you do want to see managers that do have that track record.
What about documentation that is a red flag in that it's maybe incomplete or vague?
If I see something like that right away, there's no point in going any further. If the company isn't going to take the time to provide me with the necessary documentation that I need to do a review properly, then what's the point in investing in it, really?
And I've seen actually more out west than out east, but I have seen examples where there's exempt market product that is sold not even through an offering memorandum at all, but through some sort of subscription agreement. And to me, that's a red flag. Do you both agree that that's sort of a non-starter?
100%.
Okay, now let's talk about service providers one more time. It's one thing to say, Dave, you said earlier that who you would prefer to see, but what would be a red flag where you'd say this is a red light, we can't go any further with respect to with a service provider, whether it be the auditor, legal provision, prime broker?
Well, the first thing is you want to make sure that they're independent. Maybe it's not one of the big banks, and that's cool, whatever. But you want to make sure that it is not an affiliated entity to the manager. With respect to auditor, you want to make sure that even if it's not one of the big five, make sure that it's a second tier or at least an auditing firm that has a number of clients, not just one, as was the case with respect to Madoff.
Brian, David mentioned fees, and if maybe they're a bit too high, that might incentivize the product issuer to maybe take a bit too much risk. What do you look for in that area?
What we look for is the fees should be in line with industry standards, and we compare them to industry averages, similar products, make sure they're not out of line with those.
It's one thing to have a performance fee of, say, 20% beyond a hurdle rate, and it's another thing to have a structure built in where, for example, in a land deal where the land is bought at one price and marked into the fund at another. And so I presume that this is, we alluded earlier to the kind of research that an investor cannot do themselves that requires that extra deep dive. And is that something that you would try and focus on to say, let's look at one layer beneath, follow the bouncing ball of where the money went?
Well, that's exactly what you want to do. In certain land deals that I've looked at, you take a look at what the LP bought the land for, and then you look at what they're selling it to investors. And is that type of markup reasonable given what was actually done to the land? And if it's not, then you have to note that and make sure that the investors are aware of that.
And just lastly, do either of you ever run up against management teams that are maybe a bit defensive or they just do not provide the kind of information you're looking for?
Never. Never happens. No, it happens. It does happen all the time.
Yeah.
And in some cases, you have to ask why. Is it that they're holding a proprietary trading strategy? In which case, it's understandable. If they don't want to release their most recent financials, well, that's a whole other issue that we need to look at. So you really have to take a look at how defensive they're being and try to get a sense as to why they're being that defensive. And eventually you just may have to walk away from it because you don't have the information you need to do the analysis properly.
Thanks so much for coming in, David, and shedding some light on this issue and the research you do. And you as well, Brian. Okay. Now, David, you want to talk about a conference that's coming up related to alternative investing, right?
Yes, well, and I know that Brian has been working very hard in Vancouver at putting this together, the Alternative Investment Opportunity Conference. Can you talk to us very briefly about that?
Sure. What the conference is twofold. One is education, one is opportunity. When I sat down with the BC Securities Commission a number of months ago, I learned that more money actually flows in these products than private deals or public deals, so we really want to educate investors.
Perfect, thank you.
All right, that's all the time we have. Thanks a lot for joining us. We will see you next week.